Good afternoon, everyone. Depending where you are, maybe it's still good morning. Welcome to the McGuire Woods and Houlihan Lokey webinar on key thoughts on the dental practice market and recent deal activity. We're delighted to have a couple of great folks from Houlihan Lokey with us this afternoon. Tom Cregan, who's one of their vice presidents, and Karan Garg, who's one of their managing directors. And we've had the good fortune of working with these folks on a number of dental deals and a number of non-dental deals as well over the years, and just delighted to have them with us here today. This is Bart Walker doing the talking so far. I'm a partner with the McGuire Woods Healthcare Group. My practice focuses almost entirely on M&A, and within that, concentration on dental and DSO. With me is Jeff Cockrell, who is one of my partners from our Chicago office, who also leads our equity group. Delighted to have him with us here today as well. And we're looking forward to a lively discussion. If there are questions, feel free to submit them on the Q&A panel. We will, time permitting, reference that and try to answer as many of your questions as possible on current events and the current state of the deal market in the DSO world. So please feel free to do that. Let me just kick us off real quick. I'd like to go around the horn just very, very briefly and do just the briefest of introductions so that you know who everyone is and know their voices. And then from there, maybe just open it up to a few introductory remarks. So Jeff, do you want to give a quick introduction? Then we'll turn it over to KG and Tom.
Sure. Jeff Cockrell, I'm the head of our private equity group at McGuire Woods. There's maybe 50 or 60 folks in our group. We represent private equity funds actually in all different sectors. Kind of within that, I spend all of my time on healthcare transactions, spending most of that in provider services in all of the sectors where you see a lot of private equity interest. And for the last decade, that's meant a heavy dose of dental deals. So we kind of live in this space and have seen every permutation you can think of. So we've done a lot in this. KG, maybe give a little bit of your background as well.
Yeah, thanks, Jeff, and thanks for having me on. Karan Garg, I'm a managing director at Houlihan Lokey, based out of our Chicago office. I've been with the Houlihan Lokey for 17 plus years, all in healthcare. I head our efforts in the dental space along with other physician practice management and provider spaces. Tom?
Yeah, this is Tom Cregan, Vice President with Houlihan Lokey. Great to be here. I've been with the firm over 5 years now and have focused most of my time on the dental space, where we've done more than 25 transactions since I joined. Great to be here and look forward to the discussion. Thank you.
Great, thanks guys. Let's just go ahead and jump right into it. Jeff, unless you have some preparatory remarks.
No, we can jump right in. So KG, maybe start with you. I mean, we're maybe 15 or more years into this consolidation project in the dental sector. For a long time, there were small aggregators that were kind of cobbling together a series of practices, growing them to a certain size, then selling them to larger financial buyers usually. But that's felt like it's been changing. So on the small end of the market, maybe starting there, who are the buyers of these practices? Is it strategics? Is it still a small aggregator market? From your perspective, what does that look like?
Yeah, I think it's all of the above. The landscape has changed dramatically over the last 5 or 7 years. I think from our count, approximately 22-23% of the market today is consolidated. Now, keep in mind it's a $140 billion market, so it's still a lot of runway and white space for folks to grow into. On the smaller end of the spectrum, where you're doing small practices or offices, those are still potentially mostly being targeted by larger platforms or medium-sized platforms who are looking to grow through consolidation. And it's a good exit opportunity for those doctors who are looking to transition or looking for a partnership to unburden the administrative burden that they have on a day-to-day basis. So, and that is the growth strategy that most private equity funds have backed in the space, where they're backing a platform and using the size, scale, efficiencies, and back office to generate synergies and continue to acquire and gain scale.
Great. And has in the last 12 months, how has the COVID impacted transactions in the DSO space?
Yeah, I mean, so what I would say is, sitting here a year ago, it was quite unnerving because we didn't really know where the market was going. Everything was basically shut down, and folks were really internally focused on, right-sizing their businesses and conserving cash, et cetera. I will tell you, since the market or the lockdowns opened in June of last year, the last 9 months have probably been the busiest 9 months in my career in the dental space. Tom and I have completed 8 transactions in the DSO space in the last 9 months, and the flavor has changed though, right? So what people really did, and these are companies who were forward-looking, and they had the foresight to see where the market would shake out. What they really did after lockdowns opened was ask for or seek financing, because the existing lenders were struggling with managing their portfolios, and these guys needed additional capital to grow. So we actually helped them do a bunch of different financings around various different DSOs to help them see the disruption in the market and actually capitalize on that and do add-on acquisitions. We then sort of switched to more of a sell-side mode, which is sort of regular way, and we've seen a number of those deals happen as well. And I think 2021, frankly, would be a blockbuster year from a DSO perspective, all across the board, from general DSOs, some very large DSOs, as well as specialty DSOs coming to market.
Do you think looking forward, do you think that pipeline is going to stay as robust, meaning whether that is smaller practice or larger platforms? Do you see that trend continuing with a lot of things coming to market, or does it run in cycles that you would expect that to curtail a bit?
It does run in cycles a little bit, but you also have to kind of see. So if you were to think about going back to 2014, 15, 16, those are really heavy years of private equity investment into the dental space across the board. And typically, as you would imagine, these funds are looking to exit in anywhere between 3 and 5 years. Last year's was basically a non-existent M&A year for the most part. So exits that normally would have happened last year got pushed to this year. And then on top of that, you have exits that were planned for this year that are already happening. And the third thing that is potentially pushing people to think about this is, potential tax changes coming in 2022, which is further sort of accelerating people's view on seeking a liquidity event. I mean, there are 95 or so private equity-backed dental companies in the U.S. today. They've all been invested in over the last 5 to 10 years, 10 years being the longest, 1 year being the shortest. So you will see a wave of these coming over the next 10 years as those investors try to monetize their investments.
And we'll come back to the larger end of the market because I've got a lot of questions around you get to a certain size and scale, and who are the buyers at that part of the market? What are their expectations? Do they have the same kind of growth trajectory expectations? I just think it's different, but an interesting component of it. But one kind of side note, in a lot of sectors, we're seeing payers becoming an active participant, acquiring providers. What are you seeing on that front in the dental space?
Yeah, we haven't seen that much of it. I think the payer universe here is a little bit. I think dental kind of falls behind medical in general, so they are behind the curve from how they're thinking about creating networks and thinking about value-based care, because that's when a payer would want to buy a provider. I think a good example of that, and somebody who's done it successfully, is DentaQuest. DentaQuest is a large payer, but mostly, and they do manage Medicaid networks as well. And they've done a really good job in the state of Oregon, where they have a provider network accompanying the Medicaid business that they're managing there. But we haven't really seen payers enter the provider market just yet. at least not on the commercial side. If you were to think about the Delta Dentals and the United, the Concordias of the world, because business is extremely the running of a dental office is very different than running an insurance company. So I think there's still some time for that to evolve. We haven't really seen that in this market.
Great, Bart. Do you want to take some questions?
Yeah, no, you bet. Good kickoff. Where do you see valuation multiples now? Where are they heading? Kind of how has COVID impacted that? I've got a few follow-up and sub-questions to that. I think we could probably spend an hour talking about valuations and the current state of the market. But let's start to unpack that. Like, where do you see valuations now? And again, continuing on Jeff's theme, sort of at the lower end of the middle market, and then we can kind of work our way up to the bigger DSO valuations on the horizon.
Yeah, I think there's obviously a value associated with size and scale, because it kind of tells you how evolved the business is and how much has been invested in it. So there's a premium for larger businesses, no doubt. But I think at the base fundamental level, everybody who's looking to make an investment in a multi-site retail healthcare business looks for some key elements that need to be proven out. And what COVID really did was it accelerated and sort of bifurcated companies and platforms who are well capitalized with great management teams, solid fundamentals and operating metrics, that were able to capitalize, turn the business around, reopen, and really sort of ramp up as quickly as possible, doing things right from an operational perspective. And there were others who were hurting prior to COVID because they had operational missteps, didn't have the right management teams in place, didn't have the right field people in place, and COVID just accelerated their sort of path to getting something done or finding a solution to fix it. So I would have thought that coming out of COVID, valuation multiples, there would be some vagueness or some question mark around what is the sustainability of these business models, what is the resiliency of these business models. But as I would say, that is not proven out. Like, the valuation multiples for DSOs continue to be at or above the levels they were pre-COVID. We are seeing more and more interest in specialty DSOs, whether it's orthodontics, oral surgery, endodontics, et cetera. And part of the reason for that is because they offer more growth. There's more niche-y, there's more barriers to entry, and there's more runway for growth because they're not as picked on as the general DSO. So if you were to think about orthodontics, for example, only 8% of the orthodontics market, which is a $15 billion market, has been consolidated. So the runway there is massive. Similar for oral surgery, which is a $10 billion market, and it's less than 5% that's been consolidated. So I don't foresee any sort of discounts in valuation. A lot of these business models and big companies have weathered the storm really, really well, and they're performing at really high level at this point.
Isn't that fascinating? I think we anecdotally would have expected the same. If you add an outside stressor of that magnitude, that it would tend to have a winnowing effect where it exposes rifts or fractures that are already there. But instead, it seems like it really hasn't done much to dampen, at least from a valuation perspective. I mean, has it at all impacted the seller side? Has it motivated sellers, or has it discouraged them or galvanized them to try to remain independent or go it alone? Have you seen anything on that front?
It absolutely catalyzed folks on the low end of the market, single practitioners or group practices. They realized very quickly they'd never want to go through something like this again. Applying for PPP loans, drawing down revolvers, firing people, laying off people, those who were independent. I mean, that's what really sort of catalyzed some of the larger guys to say, hey, we need to get more capital in place today, so we can partner with these practices that are great practices, have all been great practices, but they need the help from overall scalability and infrastructure perspective to make sure that they never have to go through this again. So that actually, I would say that consolidation in the DSO market accelerated in the last 9 months, far beyond what it was in prior 9 months or 12 months pre-COVID.
Sure. And to kind of carrying on one of the themes that Jeff mentioned earlier, how do you segment the market? I mean, are there clear breakpoints in terms of size and valuation and pools of buyers? We kind of just simplistically have traditionally said, if you have less than $3 million in EBITDA, that's going to discount a lot of PE funds from being part of the buyer pool. But I don't know if that's still a meaningful breakpoint or if it's changed at all. Do you have any perspective on that?
Yeah, I would say there's valuation changes between, I would say, I think one breakpoint is 10 million of EBITDA. The second breakpoint is probably, 20 to 25. And then there's a 25 to 50 million, then it's above 50 million. That's how we, at least Tom and I, segment the market and how we've seen it. And it just goes back to the types of private equity funds, the fund sizes that are investing in these types of assets at various size ranges, and also how much availability of leverage is there to support the acquisition.
Sure.
Maybe pausing there, on the larger end of the market, that's always a fascinating part of the market to me, because the trajectory that brings you up to having a platform that you're selling to one of the kind of bigger box buyers is a pretty steep growth curve, usually fueled by very aggressive acquisition strategy, maybe a very aggressive de novo strategy, but you get to a certain size and scale and it gets harder to wrap your head around that trajectory going in the same direction. How would you describe the larger purchasers of dental practices, and what are their expectations if they're different?
Yeah, that's a great question, Jeff, and I think something that people have been, wrestling with. I think as you get to 50, 60, $100 million of EBITDA, you can continue to do the bread and butter sort of, open your de novos. You can open more de novos in a given year. You can do more acquisitions of, tiny acquisitions of one or twosies across the board. But the execution burden of that is pretty high. So I think what we will see going forward is there will be folks who, the larger folks, as they trade hands over the next couple of years from one large private equity fund or medium-sized private equity fund to a larger private equity fund, they will look to make bigger moves in the earlier part of their investment cycle so that they can generate the synergies and add value to that large acquisition that they have done. So I'm thinking about consolidation of consolidators. So think about a $100 million EBITDA business buying a $25, $30 million EBITDA business up front in the very early stages of the consolidation or the investment period. And then continuing on the normal core strategy alongside that to really sort of gain scale. The other thing we will see is, I think we've seen this in Aspen, right? So Aspen that's a fantastic company. They've done a really good job sort of over the number of years continuing to grow. They're branded, it's a de novo model, but they've expanded from just being a dental provider, right? So they have 100 office, 100 location plus urgent care business that is co-located or co-joined with their dental business. So you will have to think about becoming a more rounded healthcare provider in some ways to access additional growth, and where you can see synergies from a patient perspective, where somebody who needs dental services may also need eye care services, may also need mental health services, may also need primary care services.
It's also worth noting that when you get to a certain size, the nature of the buyers can change, in that There's a segment of buyers that are looking for kind of more aggressive growth and are willing to take risk in exchange for that. And there's a segment of buyers that will value stability of a business and a business that is generating, say, a 10% cash-on-cash return year in, year out, might not ever need to be sold. There's a different segment that will value stability. So I've often heard folks kind of questioning the bigger buyer and then a bigger buyer, going back to the parable of its turtles all the way down. You eventually run out of steam of there being another bigger buyer that has an aggressive growth strategy to overlay onto a massive platform. But I think the reality is that the nature of buyers, whether those are massive insurance companies, kind of international capital sources, the expectations can change, and it doesn't have to always be a bigger, more massive, aggressive growth strategy. So to me, that gives some stability to this market, that there are kind of terminal points that aren't destructive to the smaller things building up to it, which is worth noting.
Yeah, I would also, I think Bart, Jeff, and Tom, if you chime in, if you disagree, I would not be surprised if in the next couple of years we see some of these companies go public. There's appetite for it. There's a growth story behind it. We've got great management teams at the helm, and you know, these are sophisticated businesses of size and scale that, you know, frankly should have appetite in the public markets.
I think that's right.
Just simplistically, you mentioned the kind of 10 million EBITDA breakpoint earlier. So if I'm the operator of a smaller DSO or even a large multi-location practice and I have less than 10 million in EBITDA, does that mean I'm really not a platform acquisition candidate anymore, or what does that mean in your view from the sell side?
No, I don't think that's true. That's not exactly what I'm saying. I think we were talking about sort of valuation thresholds between, you know, between a $10 million business versus a $20 million business. I think platform definition is different for different investors. Some people want to get into the ground floor and actually do the business building alongside the entrepreneur or the founder who has a vision and a strategy, even at $5 million of EBITDA. And I think they can absolutely use that $5 million of EBITDA to build a platform. And a good example of that is a business that Tom and I just advised on the sale of, or the recapitalization of, is Canadian Orthodontic Partners, which the Sheridan guys backed in 2016. And when they started off with that business, it was $5 million of EBITDA. And through the strategy and the vision of the founders and the management team and the sophistication and the business processes that they brought, they made it into the largest Canadian orthodontic business in the entire country. So absolutely, there's no reason to say a $5 million EBITDA business can't be a platform. It really requires a vision behind it.
And even though it's relatively... Go ahead, Jeff.
Part of the conversation I'm often having with smaller platforms is they see those EBITDA multiples and they want to kind of apply those to their business, when in reality they're less of a platform kind of structurally and more of just a practice, meaning they've not kind of incurred the expenses of centralized accounting, legal, ability to implement clinical and process controls over multiple locations. Sometimes that EBITDA marker can be a bit of a apples to oranges sort of comparison, which can be frustrating for smaller practices, but they need to often realize that they've not incurred the expenses of being a more integrated platform.
Yeah, agreed. I mean, and especially if those folks go to market and they run a process or, you know, solicit interest, the market will speak, right? So this is a pretty efficient market, frankly, and with a lot of sophisticated buyers and sellers. I think they'll get the black and white pretty quickly from people responding.
Let's shift gears just slightly. I mean, in terms of transaction process, it sounds like the types of deals that were getting done last year versus the types of deals that are starting to kick up this year so far and looking ahead are very different. I mean, what are some of the challenges that you have seen? It doesn't have to be necessarily valuation related, but what are some of the challenges that you've seen to getting deals done in the COVID era, so to speak?
Tom, you want to take that?
Sure. Thanks for the question. It's a good one. I guess one of the biggest challenges that we've seen is all the operational disruption caused by COVID, the change in consumer behavior, just overall from our perspective. Patients have not gone back to the dentist at the frequency they were going pre-COVID, and what that means is there could be a valuation gap between seller expectations and how buyers are viewing the business on a run rate basis. So that's certainly a challenge, and outside of that, there's some structuring nuances with government funds and so forth, but by and large, it comes down to the quality of the company and investor interest, and it's becoming more and more important for DSOs to be differentiated in their space, doing things a bit differently, have a really clear value proposition to attract strong interest from the market.
Bart, maybe turning it towards the legal end, there's a lot of discussion on kind of the state differences, and everybody knows that North Carolina's been more difficult. Can you describe kind of what that picture looks like in North Carolina now, and maybe contrast with some other of the larger states, say New York or California, just for some perspective?
Sure, and I think North Carolina is fairly infamous these days just by nature of how, choose my words carefully, how careful the dental board is in reviewing potential management arrangements with dentists. And over the years, to my knowledge, it's the only state that really has that type of process in place where the state will actually review your management agreement and provide comments to you on it. I think the one kind of silver lining of this process is at the end of it, you end up getting a letter that says, we're comfortable with your management agreement and the various financial agreements amongst the parties. But to get to that point, it's not easy. It's never been easy. I don't think we've ever said it's impossible to do a DSO type structure in North Carolina. Yes, you just have to be very, very careful and very thoughtful about it. And there's a process element that you have to go through. And depending on the type of transaction, depending on how it's structured, depending on the business deal, depending on all those variables that are typically negotiated between the dentist and the management entity, it really is a huge range of timing. We've had some get approved in as little as a few weeks if it's pretty typical and there's a precedent that we're adhering pretty closely to. Others, if it's sort of a unique transaction or has different characteristics that people aren't accustomed to seeing, it can take a year. That wouldn't be unheard of from start to finish by the time you get final approval. So I think that's the latest update on North Carolina. There continue just to be process-oriented and timing issues with that. And kind of down to the trenches and putting together the deal itself, there's always that substantive back and forth, which can be challenging, but not insurmountable. Other states, I think, can be challenging depending where you are. I think New York, New Jersey, California have their own sets of challenges. You just don't have the same predefined process that you have to go through. It's a little bit less defined what the requirements are. But I think the key takeaway is I don't think there's any state where it's just an absolute no-fly zone. I think you continue to look at North Carolina with some level of wariness or suspicion, but there are definitely people who are, doing business there. I'd be
North Carolina has been. North Carolina specifically has been a geography of focus for DSOs. I think Aspen now has close to 25 offices that they've opened there, and from a white space perspective, much more attractive given the youth of that market in terms of consolidation, and we would expect continued investment in that state given all the attractive demographic and economic trends in that region to become or remain a focus for continued growth from a DSO perspective.
Are there any other states? I'd just be curious from your anecdotal experience how the market's reacted to deals either on the sell side or even if you're looking at debt financing or debt raises. How is the market reacting to different states? Have you run into any difficulties in certain states over others?
Not necessarily. I do agree with your perspective and commentary around, New York, New Jersey, just having their own nuances, whether it be, court cases or otherwise, and have not seen a ton of investment in those states from a DSO perspective, particularly New York, and some of the larger DSOs just prefer to avoid some of those more challenging states given all the opportunity they have for growth and in other areas of the country. But by and large, from an investor standpoint, folks are looking for attractive markets from underlying population demographics growing faster than the broader U.S. and, attractive areas where young dentists want to live and work. And we find that to be most important in terms of positioning the business.
We have seen a ton of evolution in the area of provider compensation models in other sectors. It's tended to be in sectors where you've got multiple owners of very high earning doctors who can be unsatisfied with the compensation structure after a sale transaction or affiliation transaction. We've seen a little bit less of that in the dental space, with a lot of practices already kind of configuring themselves into an employment model with most of their providers. But what have you two seen on creative approaches to kind of dentist compensation structures?
Yeah, this is a really great question, and one that is obviously critical. In ensuring strong alignment with the DSO and with the doctors is paramount in building a strong platform that is built to last. In comparison to other sectors, there is obviously a lot of different creative structures that folks are experimenting with in terms of equity ownership for doctors and opportunities for investment for associates and so forth. We've seen some very innovative practices think beyond or outside the box in terms of production or collections and thinking more about the ultimate patient experience, right? And patient reviews and ratings and clinical benchmarks and how doctors are performing against their peers in terms of diagnosis and the quality of care. And not necessarily tying base compensation to those metrics, but more so thinking about potential incentive compensation to really align incentives, not just for today and production dollars, but the long term and in driving repeat patients who will come back year in year out in the future. And there's again a lot of time and thought putting into how platforms can best align incentives with their providers in that area. And in comparison to other sectors where doctors are taking material dollars off the table, I don't think you have the similar situation in dental, where production generally, at least among GPs, is less less variability there, more uniformity, and it's just less of a concern from an investor standpoint in terms of pre versus post doctor compensation.
In the doctor context, one of the evolutions has been moving away from base compensation that is production-based towards moving towards a compensation that is more P&L oriented for a particular location or a particular kind of regional subset, but kind of building it into overall profitability as opposed to individual production. I've seen less of that bleeding into the dental space, but it's been so popular and a very kind of winning strategy for kind of drawing physicians into these transactions. I think we'll probably start to see more of that in the dental space as well, but time will tell.
It all depends from our perspective, right, in terms of how the business is managed and where doctors are spending their time and what they have control over in the P&L. Not many doctors are making decisions on, the suppliers certainly have, control over the labs and whatnot. But, it's more about focusing on what doctors can control, and from our perspective, that's really the quality of care and the patient experience, and aligning incentives and focusing on what's really important to the platform in that regard.
Tom, you mentioned something interesting there about labs. Have you seen anything on the dental lab front in terms of integration with practices or consolidation on that front? That's an area that we've had less exposure to, and sometimes I get the sense that it may be even more fragmented than the dental practice space.
Yeah,
Yeah, I
it's
can
really interesting. Okay, go ahead, KG. Sorry.
Yeah, sorry guys. Tom, I think you're going to cover the same thing. So Tom and I have been extremely active in the dental lab space. We just actually helped Cerberus on the buy side to buy National Dentex, and then subsequently helped them help National Dentex acquire DSG, which is one of the larger dental labs in the space. I don't personally see a vertical integration of a lab and a DSO. I think it makes sense for certain subspecialties within the dental space, if you think about somebody who's a denture-focused business who wants lower turnaround times to serve patients, I think that makes sense. Maybe in the oral surgery care setting, that would make sense. But for multi-specialty dental practices and general dentistry practices, owning a dental lab is a completely different operation. And as we have seen, more and more production of dental products from a lab perspective is being done offshore. So if you look at DDS Lab, you look at National Dentex and others, they're all manufacturing in Asia, whether it's Vietnam or China or et cetera. So managing that supply chain, you're almost in a quasi contract manufacturing business, which is very different from a dental service business.
Right. Is that an opportunity, or is that a exposure or pressure point going forward? How reliant are some of these subspecialties to those dental lab products?
I think that market is very competitive. The customer is always, and in this case, it'll be DSOs, always putting pressure on the labs for better pricing, better products. Technology is also expanding in that case. So, for example, a lot of our clients are installing iTero scanners in their offices so they can take digital impressions, which have lower remake rates, for crowns and bridges, et cetera, which actually streamline the production on the back end as well for these dental labs. I don't see that as the way this market grows. I think we actually have seen people who used to own labs either shut them down or outsource it to a centralized lab who have more efficiencies and scale to do so.
And at the same time, I mean, do you see some of them doing this in-house? I mean, in the future, will you walk into the dentist office and have the ability to kind of manufacture it all on site? I mean, how close are we to reality on that?
Yeah. I mean, that's a big push these days. So there are a bunch of 3D printing companies focused on the dental market who claim and frankly are able to do so as well, where they're manufacturing crowns and bridges chairside in a matter of hours or minutes, as opposed to waiting for weeks. And they believe the efficacy is as good as a dental lab, and the pricing is way lower. So we will see that proliferation of those companies and those technologies into the lab, into the dental office. It's no different than sort of when the Ferric machine came through and they were doing chairside milling. It's really about sort of training your clinicians in the office to be able to do so, and whether their time spent doing that is worthwhile as opposed to doing an exam on another patient, which is revenue generating.
Sure.
I mean, I think
go ahead.
Sorry, go ahead.
No.
Yeah, I think the end of the day, it is going to be consumer driven. So right now, the consumer or the patient is the mindset is set that, hey, if I'm going to go to a doctor and he tells me I need a crown, I'll take an impression. It's going to be 2 weeks before my crown is put in. If that mentality changes to I need it tomorrow, that'll force the technology into the practices.
On the topic of kind of vertical integration, do you see much prevalence of vertical integration on some of the specialists, whether they're like orthodontic or periodontists, as these kind of platforms get larger and having a lot of coverage in, say, a particular geographic region, one of the potentials is to vertically integrate those specialists as well, which would put pressure on the consolidation on those specialists. But I'm not sure how much of that is actually or going to happen. Do you have a view on that?
So I think the question is really around, multi-specialty versus single specialty for the specialty disciplines. And our view is, joining a single specialty DSO, whether it be orthodontics or endo or otherwise. We have seen oral surgery, have not yet seen much in the way of perio. Those organizations offer a much more compelling value proposition to selling doctors than a multi-specialty practice could offer. Just given, the opportunity to join a community of your peers, folks who are established clinically, and collaborate with those folks. There are synergies in that regard that are not limited on a geographic basis, whereas to your point, it really makes the most sense for multi-specialty DSOs where they have geographic density in a particular market, and referral dynamics are less concerning to the extent that they have the patient demand, and we expect the rise of these single specialty DSOs to continue in the future, just given the benefits of joining their platform, not being limited to particular geographic regions.
That makes a lot of sense.
I know we've got a handful of questions here we could probably turn to. Let me just try to pick out the ones that are likely most relevant to the most number of people. How do we feel about California? I know we've had some experiences there. We've done some deals there. I'm not sure if KJ or Tom, you guys have recent experiences. I mean, from my perspective, California can be challenging not just for dental, but for any other professional services company, given that non-competes are in some cases illegal there, if not really difficult to enforce depending on the context. And from a corporate practice perspective, it's not the easiest state in the world, although it is navigable. I'd be curious to hear, and Jeff, obviously, chime in as well.
This is Jeff. From my perspective, the non-compete issue is less likely to hold up people moving through and doing a deal. You have to kind of make peace with the table stakes of having less hooks on providers through that mechanism. The corporate practice regime is a little stricter, but I feel like that market is going to be as doable as others. But KG or Tom, what's your perspective?
Yeah, obviously, very large market. There are some, the national DSOs with significant presence in that market, but also several rising regional platforms. Reimbursement can be challenging from Medi-Cal perspective, but otherwise, good population dynamics, obviously, and just a huge market, as attractive as any in that regard. But to your point, we would agree that one that is a little bit more tricky from a regulatory perspective.
If we talk to a lot of potential sellers, and if you were to give one piece of advice to a potential seller, whether during COVID or otherwise, what would your advice to a potential seller be? Other than get good legal and investment banking counsel, which obviously that would be your first response. But what advice would you give?
KG, you want to take this one?
Go ahead, I'll chime in.
Okay. Well, yeah, we agree in terms of hiring an advisor would be our first recommendation. Somebody who is experienced, reputable in the space, has a perspective on what makes your company investment opportunity different than others, and really can help craft the narrative around that and prepare you for all to expect in a process. These are complicated processes with multiple facets, and to help guide you along that process is super important. It's hard to understate that. But otherwise, you know, we think now is as good time as any to be entering the dental space. As KG mentioned, remains incredibly fragmented, with a lot of room for differentiation and for platforms to be innovative in you know, their value prop in comparison to others. We don't think COVID has been material detriment to the dental space by any regard, and if anything, you know, there are a ton of opportunity for market share capture from platforms that have been able to navigate this and continue to grow through COVID. And we think, you know, just given the size of the market and the opportunity to expand services, there's just a lot of levers that folks can pull in this space, and remains highly attractive in that regard. In terms of other advice in preparing for a process, it's just get organized up front and have information available to understand trends in the business and articulate the story. Data is critical in that regard, and that's where an advisor can be extremely helpful in articulating the story through graphics as well.
Yeah, Jeff, if I understood your question correctly, and maybe Tom, thanks for that. And yeah, all of those are important in processes in general, as well as regardless of COVID. But you know, obviously, it's even more important to be able to, you know, articulate the differentiation and the uniqueness of your business so that you're able to position it correctly. But if I understood your question correctly, Jeff, you were asking more like, hey, well, the question more pointed towards if advised while people were going through COVID to a potential seller or coming out of COVID. Just trying to understand the context here a little bit.
More coming out.
Yeah. I think one advice that we gave, and I think people acted on, was really sort of thinking about the future and how you would grow it, and really sort of building the business for a long term. This is a short-term blip, and as we've seen, most, you know, well-capitalized DSOs have come back to normal levels and even beyond that, and they've actually taken market share away. And the key critical part of that is having your operations in place to be able to execute, and having the availability of capital to grow.
One kind of side question to that kind of growth. It seems like a number of platforms have had a mixed de novo and acquisition strategy. Do you have any sense that, I mean, you can't do de novos forever. There's a limit on how many shiny new corner locations can go into a community. Do you have any sense on the available white space or green space for continued de novo activity? And do you think that will impact the trajectory more generally?
I actually don't think there's a cap on the number of de novos. I think both the de novo and the acquisition or add-on strategy is basically trying to take share away from the same pie, right? The pie is growing at 4 or 5%. It's not going to start growing at, just because you open 1,000 de novos, it's not going to start growing at 10%. So the strategy really needs to be is your widget better than the guy next door, and whether you're able to take market share away. So, and I think the people who are able to build de novos, run de novos, and grow de novos in an efficient manner, the return on investment on those is massive. And it's all, and I also consider it more of a controllable growth strategy, because if you're opening a de novo, you are really building it from the ground up. It's your staff, your culture, your built to spec in terms of how you want to go to market, and that has a element of scarcity value to it. There aren't that many DSOs who do de novo really, really well. Acquisitions, on the other hand, it's a faster way to grow. You're consolidating